Welcome to Breaking News to Training Moves. Today we're looking at Nestlé's accelerated restructuring plan. It's a pretty big move. We want to map out what this might mean for various U.S.-listed companies who could benefit and who might face some pressure.
Absolutely. Nestle is just such a huge player in the CPG world, consumer packaged goods. So when they make a change this substantial, it affects a lot of others in their ecosystem. Our goal here is to break down their plan and see what kind of market movements it could signal for you.
Okay, so let's start with the core numbers. What exactly are they doing? We're talking about eliminating 16,000 roles. That's over the next 2 years, which works out to about, what, 6% of their total workforce?
That's right. And it's important how that breaks down. You've got 12,000 white-collar roles, administrative, corporate functions, and then the other 4,000 are directly in manufacturing and supply chain operations. At the same time, they've upped their cost savings target. The new goal is CHF 3.8 billion, that's Swiss francs, by 2027.
Right, that CHF 3.8 billion figure seems key. But the context is a bit maybe counterintuitive. This isn't a company that's struggling badly. Their Q3 actually showed organic growth picking up around 4.3%. And real internal growth, basically volume was positive too, about 1.5%. Coffee, confectionery, those areas look pretty strong. So why the big push now?
Yeah, it's less about a crisis turnaround and more about maximizing margins. Management seems to be using this period of, let's call it relative strength, to make some pretty aggressive structural cuts. It's like saying, okay, things are decent now. Let's really push the efficiency button hard to lock in higher profits for the future. And it's the speed, this acceleration, that creates the openings and the friction points we're talking about.
Okay, got it. So let's look at the openings first, the potential winners. When Nestle is managing all this internal change, 16,000 roles moving around, who's best placed to gain some ground?
Well, the most immediate group tends to be their direct U.S. food peers. Think about it. When a company undertakes a massive restructuring, like this, cutting roles, reviewing its product lines, it often creates what you might call an execution gap. They get a bit distracted internally. Maybe their competitive focus softens for a little while.
Ah, okay. So they might pull back on promotions, maybe slow down some new product rollouts, and that leaves space for others.
Exactly that. When a major player like Nestle kind of dials back the promotional noise, even temporarily, it clears the way. It's a chance for rivals with strong operations already in place to grab shelf space or maybe even adjust pricing slightly. We'd look at companies like Mondelez, ticker MDLZ, they're big in snacks globally, and also General Mills, GIS. They both have the scale and distribution to potentially pick up some slack if Nestle is rationalizing or just less aggressive in certain categories while they focus on costs. Shelf space is often a zero-sum game.
That makes a lot of sense. Okay, what about the coffee space? Nestle is obviously a giant there. If they're driving hard for that CHF 3 billion in savings, how does that affect competitors in coffee?
Right. Coffee is super competitive. It runs on promotions, constant innovation, especially those at-home pods. If Nestle needs to trim budgets to hit that big savings number, maybe cutting back on advertising spend, R&D, or even just simplifying their range, reducing the number of SKUs, well, that gives their competitors some breathing room. They can push their own promotions or new products without facing quite as much heat from Nestle.
So less competitive pressure from Nestle potentially lets others ramp up their own efforts.
Precisely. You could see this helping Keurig Dr. Pepper, KDP. They're dominant in the U.S. at-home brewing systems. They might find it easier to push their own marketing. And maybe Starbucks, SBUX, particularly in their packaged coffee business sold in grocery stores, they could leverage their brand strength if Nestle is temporarily, let's say, constrained by this internal savings drive.
Okay, now the third group of potential winners you mentioned ties back to those 12,000 white-collar job cuts, the IT and business services firms.
Yeah, this is almost a standard playbook move during large corporate optimizations. When you cut thousands of internal admin roles, the work doesn't just disappear, right? Things like HR, finance, IT support still need doing. So companies often look to externalize these functions. They re-platform systems and shift towards managed services.
So they're basically swapping fixed internal employee costs for variable external service contracts, outsourcing the work.
That's the core idea. And these aren't small, quick projects. A restructuring like Nestlé's often involves multi-year deals for system overhauls and ongoing managed services. The obvious beneficiaries are the big enterprise consulting and outsourcing firms. Think Accenture, ticker ACN, and Cognizant, CTSH. This kind of large-scale operational transformation for a multinational is exactly what they specialize in.
Okay, let's flip the coin now. Let's talk about the companies that might feel some negative pressure from this. When Nestlé is laser-focused on finding CHF 3 billion in savings, where does that squeeze usually get applied first?
It often starts very directly with the supplier network. The first group, likely feeling the heat, would be packaging suppliers who have significant business with Nestlé. You've got that huge overall savings target, plus those 4,000 job cuts specifically linked to manufacturing and supply chain. That combination points strongly towards much tighter procurement practices.
Meaning Nestlé will likely push harder on pricing, maybe consolidate suppliers, fewer vendors, bigger demands.
Absolutely. You'd expect them to look closely at consolidating production lines, which could mean fewer packaging types needed overall. And definitely expect them to push very hard for price concessions on everything: containers, films, labels, closures. This puts pressure on companies like Amcor, ticker AMCR, and Ballcorp, BAL. They're major packaging players. They'll likely find their negotiations with Nestlé get a lot tougher, with Nestlé trying to shave costs off every unit.
Okay, packaging makes sense. What's the second category likely facing headwinds? You mentioned advertising and marketing agencies. Now, Nestlé obviously needs to keep its brands visible, but is marketing spend an easy target for quick savings?
It often is, unfortunately. It's a classic tension in these cost-cutting programs. Long-term, you need strong brands, which requires marketing investment. But short-term, if you need to hit a quarterly cash flow target, dialing back agency fees and media spend is one of the quickest levers to pull. So even if Nestlé intends to reinvest that budget later, say in 18 months, the immediate impact, the pullback right now, can hurt the agency's revenues.
Right. So how immediate is that impact, and who feels it most directly?
It tends to hit the large advertising holding companies pretty fast because their revenues are built on these massive client budgets. Companies like Omnicom, ticker OMC, and Interpublic IPG, they handle significant portions of Nestlé's global advertising, media buying, and creative work. They could see project scopes reduced or maybe some campaigns paused, especially while Nestlé's own marketing teams might be going through restructuring internally.
Okay. And the final category on the potential downside, specialty ingredients suppliers. How does that connect?
This links back to something we touched on earlier: SKU rationalization. That's basically reducing the variety of products offered. For specialty ingredients companies, complexity can be profitable. They develop unique flavors, textures, nutritional additives for a wide range of very specific products. Think different chocolate types, specific pet food formulations, unique beverage flavors. When a big client like Nestlé decides to simplify its product lines across confectionery, drinks, pet care, etc., to save costs, well, that means they need fewer unique, specialized ingredients.
So fewer custom ingredients, maybe more focus on standardized, higher volume ones that cost less.
Exactly. SKU rationalization typically leads to reduced demand for those specialized, higher margin ingredients. It also means tougher price negotiations on the ingredients they do still buy. And just a general squeeze on suppliers providing flavor, texture, and nutritional components. This could put pressure on companies like International Flavors and Fragrances, ticker IFF, and Ingredient INGR. Their value often comes from providing those specialized solutions. If the client simplifies, the supplier often has to simplify too, which can impact margins.
Okay, that lays out the landscape pretty clearly. Nestlé's push for CHF 3 billion in savings isn't just an internal thing. It sends out waves, creating pressure in some areas and potential opportunities in others across its whole network.
And it's important to remember the backdrop you mentioned earlier. The core markets like snacks and coffee seem pretty healthy right now. So the U.S.-listed companies we talked about as potential winners, they aren't trying to grab share in a shrinking market. They're potentially stepping into a healthy category where a major competitor is just temporarily a bit distracted or constrained by internal changes. That makes the opportunity more readily available, you could say.
That's a crucial point about the underlying market health. Okay, before we wrap up, we've talked a lot about the supply chain impacts and the outsourcing driven by the white-collar cuts. But thinking about those 4,000 manufacturing roles being eliminated, that must create a strong incentive for Nestlé to invest more in automation, robotics, efficiency software on their factory floors to replace that labor, right?
Right.
It makes you wonder about adjacent sectors we didn't discuss, like maybe the providers of factory automation tech. How might they fare as Nestlé looks for more efficiency in its remaining production footprint? Something for you, the listener, to maybe consider as this restructuring plays out long term.
And just a reminder, this content is not financial advice or a recommendation to buy or sell any security. This is purely the opinion of the author.
Thanks for tuning in to Breaking News to Trading Moves. We'll talk to you next time.